Hi, my name is Stephen from Share Navigator, and today I'm going to show you how to place and how to create profit and loss tables for the bear call spread strategy. Now, if you don't have this spreadsheet that you see in front of you, you can download it from our website. Just go to sharenavigator.com, go to the courses section, and visit the bear call spread strategy course. In that course, you'll be able to download this spreadsheet. So in the first section here, this is the data input section here. And any box that's highlighted in yellow will require some sort of input from you. Everything else is automatically calculated for you. So let's start with an example here. You can see we put in the stock here is SPY. So this is the example we created. But if you were doing Apple, for example, you could just type in the ticker symbol of Apple there. So we'll put it back to SPY. The current share price of SPY was 220.76 when we did this example. Again, you would change that for whatever example you're doing. The trade date is just the date you're creating this spreadsheet. Our option type here, you can see that's automatically populated for you because the bear call spread is made up entirely of call options. So there's no need for that to change. So that's just automatically populated for you. The quantity here you can change to whatever amount of contracts you're going to do. We're going to do 2 contracts. And the expiry we've chosen is December the 16th. But again, you could change that to whatever expiry you wanted by just typing in December the 9th, for example. Now there's 2 legs to the bear call spread. The first leg is where we're going to sell the whatever strike price we pick. So for this particular example, we 224, but we could change that to 225. And you can see here that the premium will change, and this will be given to you at the time wherever you're getting your option quotes from. So let's say the premium here is, 0.75. Then the second leg here of the trade is where we're buying another call option for the exact same expiry at a strike price which is above the short call strike price. So we might put in 226 here, for example. And in this case, we're paying out 65 cents. Now, watch out here if we try to put in a strike price for the long call side of the trade at a strike price that's lower than the short call. And you can see here you won't be able to do it. And that's because with the bear call spread, the strike price for the long side or the long call must always be higher than the short call strike price. The next one we get into here is our trading commissions. So again, your broker is going to give you this information. But if it's a situation you're doing this spreadsheet before you've even placed the trade and you want to put in a guess, well, if you apply a cost of about 70 cents a contract, you won't be too far wrong if you're using interactive brokers. So we're doing 2 contracts here, but there's 2 option legs to the trade, so that's a total of 4 contracts. By 70 cents is 280, so we'll put that in there. The next section here, again, it's automatically populated for you. So it's the net premium per share that you're taking in. Remember, this is a credit spread after the trading commissions are taken out. So if you look at it here, we're selling the 225 call. We're taking in a premium of 75 cents for doing that. And at the same time, we're buying the 226 call, but we're paying out 65. So that's a net credit of 10 cents there. But of course, we've incurred a cost here, a trading cost, which must be taken into consideration. And when we've done that for you, it's taking in a 1 cent reduction in the credit that you've received. And then your probability of profit. Again, this will be given to you by your broker. Any good online broker should have an options strategy probability calculator for you. And that will be given to you at the time you place the trade, and you will just put the information in here. So the great news after that is everything else is calculated out for you. So let's look at our data outputs here for the bear call spread. Well, the first thing is you know what your max loss is. It's $182.80. That's the maximum amount you can lose in this particular trade. And that's why we like it for novice investors, because you know what you can lose and what you can make before you've even placed it. And you will make your max loss when the share price at expiry is above $226. So obviously you want the share price to fall. Your max profit is $17.20, and this is achieved when the share price is below $225 at expiry. So this might look like you're risking a lot to make a small amount, but if you take into consideration your probability of winning, you can see why the trade may make sense for some people. Your break-even price is $225.09. Below this price, you start to make a profit. Above that price, you start to make a loss. And your leeway to the upside is 1.96%. What does that mean? That means that if the share price is currently trading at 220.76 and our break even is above 225.09, it means that the share price can rise almost 2% before we start to make a loss. And it's only when it rises above that level do we start to make a loss. So it's that's one of the reasons why this is a high probability strategy, because you've got a bit of wiggle room for the trade to go wrong on you. And here's the benefit really of this strategy. Your return on capital is 9.4% in over 4 or 5 weeks if you're correct on the trade. So important notes on the bear call spread. We've created profit and loss tables. We're going to go through them with you in a moment. But this trade carries defined risk and defined reward. And this is the great news for novice or total beginner option traders, because it means that you'll know exactly what you're going to make and what you're going to lose in the trade before you've even placed it. So it's a much better alternative to just doing a short call. And you should really apply this strategy when implied volatility is high. If implied volatility is low, you could switch to the bear put spread. Moving on to our profit and loss tables, well, this is like your what if scenario. What we're saying here is, well, what would it mean for us if the share price was at 215 at expiry in terms of profit and loss? What would it mean if it was at 280 and 226 and so on and so forth? So the first thing we put in here is the net credit we've received. Now, the great news for you is you don't have to do any of this. It's automatically calculated for you. But it's nice for you to know where the numbers come from. So this is just your net credit you've received for the trade. We have two call options then to consider. We've got our short call option and our long call option. And call options only have value at expiry when the share price or the call option is in the money. So as you can see here, our short call option here was the 225 strike. So there's no value in that call option right up to 225. But after that, you're seeing a lot of negative values. So how did we get them? So remember, if the share price is at 226 and we're short on the $225 call, that's got $1 of in the money value. Now, we sold 2 contracts of that, so that's a negative value for us, so it's a -2. And remember, in the options market, one contract controls 100 shares of stock, so you'd multiply that by 100. So it's a -$200. So even though there's value in the call option, because we've sold it, it's not ours. At 229, it's -800 and so on and so forth. So we do that for every potential outcome. But we also bought the $226 call. Again, you can see that there's no value in those right up to 226. But after that, there's positive value for us because this is a call option that we own. Therefore, the value is a positive for us. When we move over to the right hand side there, you're going to see all this is our profit and loss for the entire trade. And it's just a combination of adding up these 3 columns here. So it's 1720, you can see, is our max profit. Any profit is highlighted in green. Any loss scenario is highlighted in red. So you can see that our max loss as well is also included here, that we can't lose any more than $182.80. So that's what the profit and loss table looks like for the bear call spread. And this is what the chart looks like. So we've just mapped that for you. So you can see here that this is where your max loss is. And as the share price starts to fall, you then go into a max profit situation. And again, you can't make any more than this. So it's great to visualize that. At this point, we really feel you should be practicing the bear call spread in a risk-free simulated environment. If you're not a member of Share Navigator already, you should become a member. We will give you a personal simulated trading account. You'll be able to practice these trades in a risk-free environment with all real-time data. And then at the end of every month, just to incentivize you, if you come in the top 3 traders of our membership, we'll give out some cash prizes as well. It's a great way for you to learn how to trade options in a risk-free environment.